You set up the perfect trade, your analysis is spot on, but right before the market moves, price spikes, clips your stop loss, and then immediately reverses exactly the way you predicted. These spikes are deliberate liquidity sweeps executed by large institutional players. Banks and hedge funds trade with massive volume. To fill their orders without causing price slippage, they need an equal amount of counterparty volume. By pushing prices into areas where retail traders group their stop losses, they trigger the volume they need to take their actual positions. We are going to break down a strict 5-step framework to identify these stop hunts and trade alongside institutional momentum. Professional execution begins with identifying where this liquidity rests, rather than trying to predict the next directional move in isolation. Step 1. Establish your target. Start by opening a higher timeframe chart, specifically the daily or 4-hour view. This reveals the broader market trend and the key levels where orders are pooling. This chart shows exactly where orders sit. Notice the dashed lines marking buy-side and sell-side liquidity. Buy-side liquidity sits above old highs, sell-side below old lows. These boundaries act as magnets because retail traders place protective stop orders at these specific candlestick peaks and valleys. Step 2 is spotting to sweep. A genuine breakout closes aggressively beyond a level and holds. A sweep pierces that line briefly, triggers the stops, and reverses. A valid single candle sweep requires the candle body to close back inside the previous market structure. Additionally, the subsequent candle must not exceed that sweep candle's extreme point. A common mistake is the early trigger. Never enter a trade the moment a price touches a line. Entering before a confirmed close often leads to getting caught in a real, sustained breakout. Waiting for the definitive candle to close back inside the range is the primary filter that separates professional execution from gambling on a touch. Step 3. Confirm the shift. Once the higher timeframe sweep is locked in, zoom into a 15-minute or 5-minute chart to look for entry signals. Look for displacement. As shown here, this is a sudden, forceful wave of long candles moving in the exact opposite direction of the initial sweep. This displacement is the footprint of smart money aggressively pushing the market the other way after securing their liquidity. This chart shows the change of character, or CHACH. This occurs when the displacement wave breaks through a previous short-term structural high or low. While price will often have minor pullbacks, a break across this dashed threshold proves the short-term trend has reversed. The higher timeframe sweep provides the location for the trade, but the lower timeframe displacement and structural break provide the permission to enter. Step 4 is placing your entry order. Professional traders do not chase the displacement wave. They wait for price to retrace back into the imbalance left behind by that move. This chart identifies the 2 primary entry zones, the fair valued gap, a 3-candle imbalance, and the order block below it. To enter, place a limit order in this zone. The 50% midpoint of the fair value gap is a highly reliable entry level. Step 5. Set your risk parameters. Your stop loss goes just beyond the furthest extreme wick of the sweep candle, using the market structure as a shield. You must add a small pip buffer to your stop loss. This ensures that minor spread fluctuations don't knock you out of a valid position. As shown in this finalized setup, the take profit targets the next opposing liquidity pool. After a sell-side sweep at the bottom, your target is the buy-side swing high at the top. This structured approach to risk ensures that every trade is backed by a specific mechanical reason for both the entry and the exit. The complete sequence is simple. Mark the target, wait for the trap, confirm the shift on a lower time frame, place your limit entry, and define your risk. Executing a trade this way removes the emotional guesswork. When the criteria are met, the setup locks into place. Always check the broader trend before committing. Taking a sweep setup that fights the overarching higher timeframe bias will significantly lower your probability of success. Open your charts and find the previous day highs and lows. Backtest this 5-step framework to see these institutional footprints for yourself before trading them live.